For the last 3 years, being an investor has felt easy. Since the start of 2023, the S&P 500 and the Nasdaq have delivered what we call a triple-double, 3 consecutive years of double-digit growth. It's a feat so rare it has only happened a handful of times in the last century. But as we move into 2026, the path is narrowing. We've finished our walk on the solid ground of a recovery. Now we are walking on a tightrope. The Shiller P ratio, a measure of price to earnings adjusted for inflation, is now hovering around 39.4. Historically, whenever this number crosses 30, it has been followed by significant corrections. In 1929, 2000, and 2021, the result was always the same, a painful reversion to the mean. Today, we'll analyze why 2026 is the year the gravity of math might finally catch up with the euphoria of the markets. Factor 1. The AI hangover and the CapEx reality. The first crack in the 2026 tightrope is the concentration of the Magnificent Seven. These 7 stocks aren't just leading the market, they are the market. But here is the problem. Valuation is ultimately just a reflection of investor expectations. Right now, companies like Nvidia and Microsoft are priced for perfection. By 2026, big tech's combined capital expenditure, the money they spend on AI chips and data centers, is expected to approach $600 billion, as that is a staggering amount of hardware. But as the Wall Street Journal recently pointed out, if this infrastructure build doesn't translate into actual free cash flow from end users by 2026, the market will re-rate these stocks. If the PE of the Magnificent Seven drops even slightly toward historical norms, the entire S&P 500 will follow it down. Factor 2. The 4th year cycle and liquidity lag. Statistically, the 4th year after a massive bull run is rarely kind. History shows that after 3 years of blockbuster returns, the 4th year averages a return of just 4.6%, well below the historical average. But 2026 carries an extra weight, the interest rate lag. Monetary policy works with a lag of 12 to 18 months. The high interest rates of 2024 and 2025 will only truly start to squeeze corporate balance sheets and consumer spending firmed in 2026. As companies are forced to refinance debt at higher rates, margins will shrink. This is the liquidity trap that often triggers a negative 4th year. Factor 3. The May 2026 pivot. Then there is the black swan that is actually scheduled on the calendar. In May 2026, Jerome Powell's term as Fed chair expires. Markets hate uncertainty, and the replacement of the world's most powerful banker is the ultimate uncertainty. Whether it's Kevin Hassett or Christopher Waller, the shift in leadership can cause immediate volatility. Couple this with geopolitical tensions in the semiconductor supply chain. If supply chains for the chips powering the Magnificent Seven are even slightly disrupted in 2026, the House of Cards loses its foundation. We are walking a tightrope where one gust of wind, political or geopolitical, could lead to a sharp correction. So how do you survive a potential 2026 fall? You follow the 1999 Buffett playbook. In the heat of the dot-com bubble, Buffett didn't try to time the crash. He simply practiced bottom-up investing, judging each company on its own merits rather than following the macro hype. He avoided the high flyers and bought undervalued moats. Build a cash buffer. As Buffett says, when it rains gold, reach for a wash tub, not a thimble. If 2026 brings the correction the data suggests, you want to be the one with the capital to buy quality businesses at a discount while everyone else is panicking. Stay rational, stay patient. But what do you think? Do you think AI results will catch up to valuations by 2026? Or are we in a bubble? Let me know in the comments below.